Hello value investors, thank you for joining me. In today's video we're going to talk about dealing with uncertainty when investing. So if you're new to the channel, please subscribe now so you can get my next value installment. Also, if you're interested to know which stocks I own, come over to my marketplace on Seeking Alpha. It's called Deep Value Returns, where you can check out which stocks I own and why. I give a balanced argument for those stocks. So, when it comes to investing, there are going to be unknowables. There are things that you're just not going to be able to control. So, the first topic that's worthwhile discussing is when something is a bit challenging, don't force it. If you see an investment kind of has the right criteria, but you can't quite make it out, just put it to the side. Something else will come either in a few weeks or a month or two. Don't try and force it just because you kind of looked at it and your friends invested in it or someone you told it is invested in it. Don't force it. It needs to make absolute certainty. What I always go back to is when you make an investment in a company, it's the same level of due diligence you need to put in as when you're buying your own home. So that's the level of certainty that you need. When you're going to commit yourself to moving yourself and your family to a new home, you spend quite a few months getting to know the company or the house. So you look around the neighbors, you try and get a feel for the neighborhood. So that's the level of due diligence you need to put in. And if it doesn't seem right, something kind of seems odd, just pass it, okay? The next thing I think is worthwhile discussing is the hard catalyst. Many people say, so what's the hard catalyst for this stock? Now, in reality, if you know that there's a catalyst, that means everyone else knows there's a catalyst. That means it's probably priced in already to a certain extent. Most investments, even if there is a catalyst on the horizon, it kind of comes around and it passes and nothing really happens. So that's not a reason to sell out of your investment just because the catalyst happened how you thought it was going to happen and the market didn't react. Sometimes the market is a bit slow picking things up. So don't build the thesis on just a specific catalyst because that's quite difficult. Even if, for example, it's like next quarter and it's a difficult game. Try to align yourself with the power of the business. The earnings power of the business is what's going to lead you to have a higher return over time. The way to deal with uncertainty is simply by putting the cards in your favor while being aware that you're not going to know everything about an investment. The next criteria that I think is worthwhile discussing is when you know that the next quarter is going to be rough. You don't know how it's going to unfold in the subsequent quarters, but you have this huge uncertainty, this huge question mark, how it's going to come out. For example, let's say that you're investing now in 2020, and more likely than not, despite what the market is telling you, Q2 is going to be quite rough. Q2 2020, when companies start reporting through the lockdown period, it's going to be rough. Okay. Now, let's say you've picked out a very high quality company, and you're in a situation where you like this company, the company is doing well, it generates a lot of free cash flow, got a video about free cash flow, and you are unsure. So you know that quarter is going to be rough because the comparisons year over year are going to look quite rough. Don't be in a situation where everything is timed down to that one quarterly result. Try have a forecast where the company is going to be over the next 5 years. That should be really in your mind. Remember, the market is quite forward-looking, so you don't need to look out the full 5 years. You just need to look out 4 years because by the end of the fourth year, the investors are already looking out for the next year. But you do need to understand, is the company going to be more relevant or less relevant? Because it's quite rare for a company just to stand still in its market. You either taking market share or you losing market share. There are some exceptions, obviously, if you have a monopoly, etc. But more often than not, business is quite dynamic. Remember what Jeff Bezos says? That most businesses only last 30 years. It's rare. And you look yourself at the Dow Jones, there are very few businesses that have been around for 100 years. the lifespan of a business is only approximately 30 years. So if there are already question marks, there's a lot of uncertainty already in the business that you're looking at, it might not be the business for you. Also, remember, it's a lot about doing the due diligence. So go back to the balance sheet. I've got a video on balance sheets that helps you out. So just be an owner of the business. So if you have a business that has a flexible balance sheet, it doesn't need to be debt free, but you have a business that has enough cash to offset that debt, even if there's more debt, even if, let's say, leverage at 2 times to EBITDA, you want to be aligned yourself as an owner of the business. Now, the thing to look out for is how investors are expecting the business to be doing. So if there's a high expectation, it might not be a very good investment, because if there's a very high expectation, more likely than not, especially now in 2020, investors are pricing that in. So you, in the ideal scenario, you want to be in a business with high medium expectations or low expectations. Low expectations, more often than not, something can be wrong fundamentally with the business, might not also be the best thing. You want to be in the middle of the range, because if the expectations are very, very high, you look at these software as a services business and their expectations are so high because investors are locked into the idea that their customers are locked in. That's not the best way to go. If you're paying, let's say, 20 times sales, I mean, it's very difficult for you to have any more wiggle room on that. So when it comes to dealing with uncertainty, put the cards in your favor. Check out the balance sheet. Make sure that balance sheet is quite strong. It doesn't need to be perfect, but it needs to give you the ability to withstand certain risks on it. So you just need to put the deck in your favor. So when it comes to dealing with investor uncertainty, check for businesses that have medium expectations. You don't want expectations to be too high. You don't want to be paying over 20 times sales. You want a business that is growing in strength, and you also want a business that's quite predictable. That does not mean you need the customer locked in. All I mean by that is that the business's operating margins should be quite stable over time. We don't want a business that one year has 2% operating margin, next year has no operating margins. You want a very easy business, because investing is really, really difficult by itself. You don't want to add an extra layer that the business is too cyclical and you're trying to price in too many different things. I see a lot of short sellers that they kind of have the idea, okay, the business is unfolding, there's a lot of risk, and they kind of overcomplicate the thesis. Make it really, really simple. Align yourself as the owner of the business so that you can withstand the uncertainty. So in that event, you want a business that has got some wiggle room, so that when things happen unexpectedly, unexpected risks take place, you can still kind of continue to be a shareholder of the business. You don't want to be in a position that you're kind of a forced seller because the business did something quite crazy and everything was priced to perfection, expectations were too high. So just try to figure out outside the box slightly and think, okay, this business might not be one of the household names, might not be the coolest business in the world, but it's ticking along. It's serving a certain customer base, and it's quite predictable, it's quite stable. That's what you really want. You don't want to be paying too much for stable business, but you can just see these businesses that are priced too high. You know when something is wrong. You know when something is kind of offish. You know when you're paying too high a price. So I hope you found this video useful. I got a lot of stuff on Marketplace to help you figure out which stocks I'm interested in, and you can see balanced argument for the stocks that I own. And remember, please subscribe. I'll see you soon.